Hey there, tax fans. Welcome to State Tax Talks with me, your host, Joe Tantillo. I'm a tax attorney at the Hodgson Russ Law Firm looking to explore the nuances of state and local tax law. Here on the show, our goal is to keep tax informative, simple, and fun. So if you're ready to talk tax, turn up the volume and dive into this episode of State Tax Talks. Ladies and gentlemen, welcome back to another episode of State Tax Talks. I am Joe Tantillo. I'm here with Joseph Endres and Craig Reilly. This is the final part of our discussion about sales tax issues related to software as a service. The first question for those out there listening is, are we seeing states audit businesses who sell these kinds of products more aggressively or more regularly even?
The answer is yes, absolutely, 100%. Again, I was just at a presentation that kind of looked at some sales tax statistics nationwide, and the third highest category of transactions that result in sales tax is these digital transactions. So now it's third highest nationwide, behind just going out to dinner, restaurant sales. And I forget what the other
one was. Car sales?
Oh, that was it.
I knew it.
Sales, that's exactly right. So those are the big three. But the point is that because it's such a big category, such a big revenue category, of course you're going to see audits in that. And states are absolutely focusing on this in part. And, this is the cynic in me. Maybe it's having spent so much time learning from Mark Klein, but it's who better to go after than businesses that aren't here.
Right.
And the software transactions allow a state like New York, which is a business center, a population center, but they can go after businesses that are outside New York, but selling to New York users. And who better to go after than that? You're not getting, you're not angering a natural political constituency, right? So you go after those businesses outside the state, you take aggressive audit positions with respect to them, and there's not as much blowback as actually going after New York businesses.
I've sat at some industry presentations, seminars in the past. Another word for software as a service, we referred to it as cloud computing, and people talk about being a kid laying in the grass, looking up at the clouds. What do you see? Tax departments see dollar signs. That's what they see when they look up at the clouds, and they are extremely aggressive in this area. And going back to something we mentioned at the beginning, both on the sales side and on the purchase side, I would say that I probably spend as much time arguing about the taxability of whether something is or is not taxable software as a service in New York on use tax purchase audits as I do on vendor sales tax audits.
Interesting. So if I'm, Johnny taxpayer, I've got my business that sells software as a service. What are some basic things I should keep in mind if I get an audit notice? I think when we did our sales tax specific audit episode, I think the first questions that you hear and are often, am I going to go to jail? How much is this going to cost me? What do I even say? I mean, what reassurances would you give to someone who's getting an audit notice and who's in a full-blown panic of to reframe their mind for the audit?
Well, I would say for the best time to think about this is before you get audited.
There we go.
Yeah, that's the best time to think about this. We can do some therapy here in a second that if listeners are already under audit, but the best time to think about this is before you're audited, and it is things like, does your service agreement, which is often publicly available on your website, does it actually reflect what you are selling? Or do you have an argument that you really are a service provider, but you have this license agreement that describes software access in detail that isn't really reflective of what you're actually selling, in which case you probably want to clean that up before you get audited. Or if you realize that, I do have some real exposure here. States have things like voluntary disclosure programs that you can look at and try and sort of cut off some of the potential exposure and get ahead of the issue, especially in the software industry where, there's no shortage of sort of M&A, merger activity, outside investments, and anytime there's outside funding coming into some type of startup, there's going to be a due diligence process. There's going to be a sort of, let's see what type of skeletons are in the closet. And you don't want to be going through this process when you've got a potential purchaser looking over your shoulder at every step of the way. So again, best time to think about this is before you get audited. But if you do get audited, you're probably not going to jail. We can help you. But I'll just reiterate that the best time to think about this is before an audit.
Yeah, it's funny. I'm of two minds of it, meaning that, I would prefer, like Craig said, to get in early and to be able to advise the client, before there's potentially years worth of liability sitting on top of it. The problem with it is, though, that's usually when the business is least able to deal with the compliance burden. That's when it's a startup and you don't have the big influx of cash yet, and you're trying to make this thing into a success. So I tell them, you've got to worry about sales tax compliance in 20 different states. And yeah, there's services out there, but that's going to cost money. So it can feel overwhelming for startups, and I feel for them. I agree with them completely. It is the current state of affairs here is definitely overwhelming. And then on the flip side of that, there's like when we're going to sell the company and, folks coming in doing their due diligence. Well, the problem with that is, now you've got probably more of a developed infrastructure or company with maybe a little more resources. But there you have years worth of liability potentially in multiple jurisdictions. So it's like, pick your poison. I mean, both are difficult. And just think about this. It's not just, it's one thing to know the rules and to get it right, but it's a whole nother ballgame to stay on top of it. What do I mean by that? Last year, there were 444 rate changes across the United States. 444 rate changes. So wow. It's a matter of ongoing compliance too. To make sure that your sales tax obligations are correct.
On the ongoing compliance piece, the one thing I'll note is there are the Avaleras of the world, the tax jars, the hosted software programs that can help you determine the taxability of hosted software. I don't think that they are not a replacement for sort of detailed advice and analysis. But how they can be and when they can be used most effectively is if before onboarding with a program like that, there's an opportunity to step back and really think about how you're even coding your sales within that program. Because again, the way that those programs work is there are hundreds, thousands of product classifications that you can apply to what you are selling. And in theory, that program is then meant to help you navigate the 4,000 different rates, the rate changes. But in order for that to work properly, you have to have initially properly coded your product to understand why what may seem like a minor, insignificant distinction really can make a material difference. And so I will always tell people, I'll say, look, I think that you should look into the use of those programs. Absolutely. It can make your life easier. You don't want to be doing this yourself. It makes it more containable. But before you get rolling on that program, talk to us, talk to somebody else, and sit down and make sure that your products and services are actually being coded properly into those platforms so that they can do what they are supposed to, which is help you effectively navigate this and not run up on surprising liabilities.
Yep, it is the quintessential garbage in, garbage out. If you don't code it right at the start, then all the stuff that comes out, all the compliance that it does is potentially garbage. It's potentially also not right.
Have you seen situations where people just took the ultra conservative approach and charged tax on everything, collected it, remitted it, and then they're coming to you to say, we'd actually like to know whether we're entitled for a refund now because we've just been collecting tax on all our transactions?
Yeah, so a couple things on that. First off, it's usually not the business's refund, right? It's the customer's refund in most cases. So it wouldn't be the business that would go to the tax departments to get money back. It would be their customers usually. But the other thing that they have to worry about, the problem with just turning on the tax and taking the conservative approach is that if you charge tax incorrectly and you can't answer a question from a customer, they shoot you an email or call up and say, hey, why are you taxing me? You should have an answer to that. You should have a reason for why you're taxing in a specific jurisdiction. But and the downside to not being able to answer that question is, believe it or not, a potential class action lawsuit. If you're charging tax unnecessarily, and this happened to some pretty substantial companies, they were subject to a class action lawsuit. So you got to be careful. You have to be careful about being overly conservative as well.
Those class action lawsuits certainly exist, and it's a burden to deal with. And they've gone after some of the biggest providers and biggest vendors out there. For the most part, it seems as though vendors have been able to defeat those. Again, still a cost, still a headache dealing with them. But the other issue is just the competitive disadvantage, right? If you are unnecessarily overly charging tax, especially in the business to business B2B context, where you have sophisticated purchasers, maybe you have a sophisticated customer that has their own internal tax department. If you're not going to turn off that tax and your customer thinks that you should, and there is another vendor that sells a similar application somewhere else that's not charging the tax, well, they may slide into an 8-10% savings. And if they think they can go elsewhere and correctly get the same product or service without tax being applied, again, on their view that this is the correct way to do this, they will be incentivized to go look somewhere else to receive that service.
Right. And sales tax have been rising. It used to be one thing when this was 2-3%. But now, like Craig mentioned, 9-10%. I mean, Louisiana leads the nation in the sales tax rate. So these are meaningful dollars at significant rates.
And how about the flip side of the people who are taking huge risks and they want the competitive advantage and they're just thinking like, I'm never going to get caught. Like these states are never going to find me. I don't have an office there. I don't have people there. Like maybe I'm big, but I'm not big enough that I'm going to get on their radar. What would you say to them?
Well, it's funny. I would tell them to worry about software as a service. And what I mean by that is, tax departments are now using software. They're using technology to find audit targets. There is now just so many different ways to cross-reference information and to, essentially what tax departments are doing is using software to understand why two numbers don't make sense in relation to one another. I mean, that's basically what the software does to find audit targets. And it's to the point now where if you are purposely playing games, purposely underreporting, thinking you're just never going to get caught, to me, it's not a question of if you get caught, it's a question of when, because states are there's just so many ways for them to cross-reference information. I mean, states get information from financial institutions, credit card companies, banks, liquor distributors. I mean, it's just from all over the place where the software now takes in this massive heap of data and says, hey, you might as well look at this business over here. These two numbers don't make sense together.
And if you're because I've had conversations with, I'll characterize the true libertarian crowd waving a "Don't tread on me" flag. You would say, I don't care about this. This isn't my problem. Then I'll say, well, look, do you have any ideas of an exit strategy here? Are you ever looking to sell this business? So you might not care what the state governments think. I think you should, but okay, fine. I'll stand on that hill with you. But again, going back to a point we mentioned earlier, if you're looking to sell this business someday, I'll tell you who is going to care. And that's the private equity firm that's coming in to acquire your business because they don't want to take on this liability. So you might not care, but your potential purchaser absolutely will care.
And I know we said at the start of the section, like you're probably not going to jail, but I have to imagine that if you are purposefully underreporting and with knowledge that you start to get into the tax fraud camp and end yourself up in some very hot water.
Yes, it's not. So not charging tax isn't quite as bad as charging tax, but not remitting it, but it's still not good.
All right, let's move into the final section here, and this is going to be relatively brief, but I figured, we would talk about what's coming next and just give some parting thoughts on this subject. I was looking at slides that Craig sent me yesterday from a presentation, and one of these slides just said the metaverse with 3 question marks, and it did make me immediately think, what about this software as a service, like within a metaphysical universe that takes place entirely on the internet, right? Like what about sales within the metaverse. I think that's a thing now, right? You can go to like a Gucci store in the metaverse and buy sneakers for your digital avatar. Like where is all this headed?
Well, I think, some states are already there. I mean, some states have changed their sales tax laws to actually tax, quote, digital products. So there are digital products taxes out there that are kind of, I think, perfectly positioned for that whole next phase of economic activity. I will say, New York is a little bit conservative in this approach, right? I mean, we've been talking about software as a service, and certainly New York taxes that. But unlike many other states, New York doesn't tax what I call simple digital transactions, things like streaming. If I get Netflix or Apple Music or Spotify here in New York, those are digital transactions that are not subject to New York State sales tax. If I have if I buy digital photography, these are not tangible personal property or items of tangible personal property. It's not taxable in New York. And what I think states are starting to feel now is there was a glut of sales tax revenue during the pandemic. Sales tax collections actually skyrocketed in 2021 and 2022 because people were stuck at home and we were all learning how to bake sourdough bread and, buying new furniture and stuff. So there was a lot of sales tax activity and revenue for the states to use. But 2023 now is the first year where the sales tax collection revenue we've seen nationwide is basically where it was prior to the pandemic. And so that nice bump that states were kind of getting fat and happy with is gone. And one way to kind of replace that revenue or to, if they do want to seek additional funds is to move into this digital space. And certainly, at least here in New York, there's a huge opportunity to do that. I think that will be happening. Just this recent budget back and forth, there was a provision to start taxing Airbnb. Now, I know that's not a digital transaction. You're actually renting a real property, a place to spend your vacations. But I kind of think of it as technology because it's like a home share. You think of the app there. And that's where states, including New York, especially New York perhaps, are going to be looking for, I think, revenue going forward.
And again, it's the idea of seeing dollar signs in the cloud, right? I mean, the other area we're seeing a lot of activity is states with these digital advertising taxes. And there you will notice if you dig into the weeds at all, the thresholds of who those taxes would even apply to are astronomical. I mean, we are talking about the largest technology companies in the world. You're going to need to have tens, hundreds of millions of dollars in digital advertising revenue to be subject to these taxes. But the reason that states, I believe, are doing it that way is they want to be strategic about the fights that they're picking. And they know that, all right, well, we're not going to get bogged down with every small vendor. But if we set these high thresholds, that's a fight we're willing to take. Because if we're right, that's big money on the back end.
Wow. A lot to think about. Any big cases or anything in particular that's coming down the pipeline that either of you have your eye on?
I think the primary function cases that we've seen in New York, we've seen a few recently that are definitely worth a read. And then I think the state's initiatives with the digital advertising taxes, obviously Maryland seems to be out in front, at least in terms of the ongoing litigation on that issue. That's something that I'm definitely keeping an eye on.
And I'm still looking for that case to take down New York software as a service regimen.
That's the one. All right. I think there's a lot more that we could discuss. My mind, as we were talking about the metaverse, was starting to thinking about the sourcing implications of like transacting with other businesses while you're in the metaverse when you're somewhere away from home wearing your like MetaQuest headset, and it's enough to make your brain hurt a little bit.
The reason there were 3 question marks on that slide that I put together was at that point, and still today, I don't know what the metaverse is. So it wasn't a sales tax question. It was actually just a question of what is the metaverse.
Somebody please email Craig Reilly and explain to him what the metaverse is. I've never used it, so I honestly could not tell you in detail. I think it's much more complicated than to me. It's like playing The Sims. Like, you remember The Sims? Like, I think of it as like playing The Sims, but you're in The Sims. But I think it's far more complex than that. It's basically like living a second life on a digital plane. That's for another day and for someone with more technical knowledge than this table has. But and any final thoughts from either of you?
No, just as we said, this is something that is incredibly prevalent, and it impacts every industry out there.
Yeah, and mine is just maybe a word of hope to those businesses out there listening to this, thinking, "Oh my gosh, how am I going to deal with all of this?" Just know you're not alone. There are a lot of every business has to be thinking about this now, or it's going to be a problem. So stay strong, and certainly there are advisors out there to help you with it.
Yes, indeed. Well, thank you, Craig. Thank you, Joe. I appreciate both of you joining the show today. For those of you listening out there, I am Joe Tantillo. This has been State Tax Talks, and we will see you next time. Thanks for joining us for another episode of State Tax Talks. If you're interested in listening to more episodes, we're available on all platforms where podcasts can be found, including YouTube. If you enjoyed this episode of State Tax Talks with Joe Tantillo, please give us a 5-star review on your favorite podcast platform. And if you're in need of a tax professional, you can contact the tax attorneys at Hodgson Russ. Go to www.hodgsonruss.com for more information. And until next time, I'm Joe Tantillo, and this is State Tax Talks. Catch you later, tax fans. The comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm.